Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings, Barry. It's great to have you on the podcast once again.
It's been a while.
Yeah. And so you recently presented a paper at the Jackson Hole Symposium that was called Living with High Public Debt, that you co-authored with Serkan Arslanalp. It's obviously a very topical subject. You know, everybody often talks about high debt levels and people start to come up with all sorts of apocalyptic scenarios, but you did a very sort of rigorous analysis of how to think about this. So perhaps we can start with some sort of high level observations about trends in global public debt and why it's relevant for us to look at it now. Maybe we can start with that before going into how to fix the problem.
Sure. So maybe as background, I should mention how the Jackson Hole process works. The Kansas City Fed invites an author to write on a topic broadly defined, like public debt, global public debt in my case, but doesn't provide any prescription or specifics about what to write or what approach to take. So Serkan and I, who'd worked together on the dollar and related projects, sat down together to think about what approach we would take. And we thought it important, first of all, to take a global perspective on the issue. Sitting in the United States, there's a lot of talk about the debt in the hands of the public relative to GDP approaching 100%, which some people view as a critical threshold of some sort. But the problem of rising public debts is global and not only US specific. So we tried to paint that picture looking globally, but also looking separately at the advanced economies, at middle income emerging markets, and at low-income countries, and showing although the level of debt is different, low-income countries are able to borrow less. The trends are similar, up, and up, and the jumps up are associated, not surprisingly, with global crises of one sort or another, the global financial crisis and euro crisis of 2008, 2009, the pandemic, of course, and the European energy crisis that followed shortly thereafter. And what is striking is that the standard economic remedy to this problem, which is that you run budget deficits in bad times in response to emergencies in order to finance the all-hands-on-deck public policy response to that emergency, after which you pay down the debt, you restore your ability to borrow in good times. We're good at doing the first, responding to emergencies, not so good about doing the second, which is paying down that high public debt.
It's good that you mentioned sort of the Jackson Hole sort of setup, and I actually didn't know it wasn't prescriptive as it would appear on the outside. Another thing I wanted to ask is, I mean, how different is it from an academic conference? As an outsider, it feels a bit like an academic conference, but presumably it must be different because it's in a policy setting, policy makers, and it's much more applied and so on.
Yeah. So academic work tends to be one step removed from policy, and in the room at Jackson Hole, there are a bunch of people, central bank governors, finance ministers, representatives of international organizations that are not one step removed from policy. So people jump to the policy implications as opposed to the methodological controversies more quickly. And the other thing I would say is that the Jackson Hole discussion, while equally spirited, is more polite. Academics fighting amongst themselves are not renowned for being polite. So people interrupt after the first sentence. They talk out of turn they can be highly, highly critical. And my experience at Jackson Hole, having been there a few times, is that decorum is better. People raise their hands and wait to be called on, and they're relatively constructive, relatively polite.
Okay, that's good to know. It must be a nice, refreshing break from the academic world then. So you've said essentially that number one, it's useful to look at the global picture, and you've also said low debt countries have also seen a big jump in debt. So the direction of travel is one way; it's higher. And in terms of the structure of the debt and who holds the debt, I mean, are there any sort of stylistic points you could highlight?
Absolutely. So, across the board, one tends to see a movement away from official finance or intergovernmental finance, where, there still exists official finance where the Chinese government lends money to the governments of various emerging markets and developing countries. But the trend has been away from that kind of official finance and toward market finance. Not so much in this day and age, banks lending to banks in other countries. There was something of a crackdown on that practice following the global financial crisis and um, uh, the euro crisis, stronger regulation of the international interbank market, but more flows of funds through global bond markets and to a lesser extent, global equity markets. So what that means is there are more players at the table when something has to be discussed, not only the advanced country governments that are members of the Paris Club, where intergovernmental loans are discussed and renegotiated, but also institutional investors, hedge funds, insurance companies, pension funds, and the like, making for a messier process when things go wrong and debts have to be restructured.
And the other one, this is probably more relevant for emerging markets, is the whole currency debate. So there was a period historically where many, or if not most, emerging markets would have to issue in dollars in order to attract international investors. Over the past 10, 15 years, there's been a lot more local currency issuance. Certainly, I've seen that as a financial market person. Is that important as well? I mean, are you seeing a much larger share of local currency issuance, or is it still dominated by hard currency issuance?
As with many things economic, the answer is yes and no. Parenthetically, the importance of foreign currency denominated debt and the difficulty that many developing countries have in issuing it was the topic of my earlier Jackson Hole paper in 1999, 24 years ago. So I get invited periodically. That paper was called Exchange Rates and Financial Fragility because it pointed out that if you have dollar debt and your exchange rate weakens, your financial markets can be destabilized by the increase in the local currency cost of servicing and repaying that debt. So Sirkan and I looked again at that question, and what we found was that while a number of large emerging markets have moved very significantly in the direction of being able to place domestic currency debt with foreign investors, the same is not true of a large number of smaller, less developed economies. So India issues entirely rupee-denominated debt. China issues debt denominated in its own currency. South Africa, a number of other large emerging markets. But if you look across 180 countries, across 150 developing countries and emerging markets, you find that the vast majority of them, when they try to place debt bonds with foreign investors, those bonds are still denominated in dollars. And the other thing we observe in the paper is a point made by Yun Shin, the chief economist at the Bank for International Settlements, and his co-authors, that even if you issue local currency debt, peso-denominated debt, if you will, to foreign investors, your economy can still be destabilized if the exchange rate moves. because those foreign investors try to flee the market before the exchange rate depreciates and the value of their peso-denominated bonds declines. They suffer, if you will, a double whammy of a decline in the local currency value of the bonds, and then because of the exchange rate movement, the dollar value of their bonds on top of that. So there is a rush out of emerging markets when things look like they're going wrong, even if the debt of the emerging markets in question is denominated in local currency. So we think less has changed on that dimension than many people assert.
You know, that's a great point as well, that issuing in local currency, there's no panacea. There's still a risk there. There's no free lunch anywhere in the system. Now, if we go into how we can bring the debt down, I mean, obviously, there's a number of different channels countries have engaged in over the years to do this. The most kind of direct is to run budget surpluses, or more specifically, primary surpluses, so surpluses outside of interest payments. You know, how that seems like the orthodox thing to do. You know, how common is it? Is it the right thing to do? Does it work? What did your research find around that?
Well, running primary surpluses is, as you said, the obvious way of bringing down high debts. Number one, if it can be done politically, and number two, if it can be done without crashing the denominator of the debt to GDP ratio. So there has been work in the European context by the late great Alberto Alesina and co-authors about how if you run primary surpluses by cutting expenditures, that tends to be growth friendly and won't crash the denominator of the debt to GDP ratio. Sirkin and I look at that in more depth, and we think that European prescription does not apply across the board to other economies. In the United States, the problem is not too much public spending, but too little taxation. That tax revenues as a share of GDP are well below the advanced country average, and that there is widespread opposition in the Congress for reasons good and bad to raising taxes. There was, as we speak today, there is an article in the Wall Street Journal, I think, describing bipartisan opposition to raising taxes and what that implies for the debt. We look, Sirkin and I, at the politics of primary surpluses. We look at a sample of like 40 advanced countries and middle income countries, and show that episodes where such countries have been able to run large primary budget surpluses for extended periods of years are very much the exceptions to the rule. And exceptions occur when there is political consensus. Political polarization is a problem for running primary surpluses, and when there is strong economic growth, so that the pain associated with running primary surpluses is less. And we think, given the rise of political polarization in many countries and the relatively dim prospects for economic growth, if you buy the forecasts of the World Bank and others, that primary surpluses are unlikely to enable us to dig our way out of this problem.
And I'm just asking your opinion on this, but do you think some of the austerity measures after the global financial crisis is part of the reason we've ended up with this opposition against running surpluses, and perhaps even sow the seeds for some of the polarization? I mean, this is kind of a very big question I'm asking, but in Europe, at least, that was a fairly sort of big issue.
Yeah, I think that is very much valid diagnosis, that the fact that Europe in particular, but the advanced countries more generally, turned toward austerity too early and too dramatically after the global financial crisis, made for a decade of slow growth and wage stagnation. So we collectively responded very differently to the COVID crisis, pulling out the fiscal stops. Um, Modern monetary theorists and others concluded that interest rates would remain low forever and budget deficits would not fuel inflation under any conceivable circumstance. So some of the conclusions drawn from that earlier experience were accurate, some were grossly inaccurate, but history informs people's views of appropriate responses to current events. I think what happened in the second decade of the 21st century in terms of slow growth, inequality, uh, did fuel political polarization. So that combination, number one, the lessons drawn from history by opinion makers and political polarization as a fact on the ground, those two factors contributed to the uh, disregard of the need for fiscal balance, for example, and resulted in what I think was excessive fiscal stimulus in the United States at the beginning of 2021. That was one of several factors, along with supply chain disruptions and so forth, that fed our inflation.
Yeah. Okay, so it sounds like primary surplus is it's in theory it sounds good. In practice, it's often very difficult, and the current political setup doesn't seem that amenable to it. Now, another way to bring down the burden of debt is financial repression. Now, just for the benefit of our audience, maybe if you could define what you mean by financial repression, and then we can talk a bit more about it.
I mean regulations and controls that um, prevent financial markets from operating as they would otherwise. In the United States, we had something called Regulation Q until the end of the 1970s that capped interest rates on bank accounts and provided an incentive for savers to put their money in government bonds as opposed to exclusively in bank accounts. In Europe, there were various capital requirements and preferences that encouraged commercial banks to load up on their own government's bonds. And those regulations were kind of another set of controls and preferences that caused financial markets to operate differently than they would have otherwise. So there are people out there who suggest that in developing countries and emerging markets in particular, where there is extensive regulation of banks and financial markets, we are likely to see more of those measures, and maybe even in the advanced economies. So Sirkin and I push back against that view. In the paper, we think that with the digital revolution and with financial liberalization more broadly, the genie is out of the bottle, if you will. There are a few places where interest rates remain regulated. China springs to mind, where the banks are encouraged to load up on government bonds. Turkey springs to mind. But more broadly, I think the scope for financial repression as a solution to this, to our debt problem, is very much reduced relative to the situation in the decades after World War II, the period widely viewed as the heyday of financial repression.
And how about bank regulation and how they assign risk to banks holding, say, treasuries or government bonds versus other assets? I mean, that's a quite common way that incentivize banks to just hold a lot more government bonds.
Right.
Um,
And it's a quite common way for banks to get into trouble. Silicon Valley Bank got
yeah.
into trouble holding government bonds and not hedging the interest rate risk. A bunch of European banks got into similar trouble in the run up to the Euro crisis in 2009, 2010, causing economists to refer to the diabolic loop connecting governments' sovereign debt problems on the one hand with banks' balance sheet problems on the other. So regulators, in their wisdom, regulators are always responding to the last crisis, have been tweaking regulation in ways that discourage banks from holding their own government bonds, and make it more difficult for governments to force feed those bonds to their banks.
Okay. So financial repression is unlikely to be the the answer here either. Now, inflation. I mean, this is probably the oldest game in town. In ancient times, you clip the coins and all of these sorts of ways of reducing your debt burden. And of course, over the past year or two, the governments have been able to benefit from unexpected inflation. So, the central banks have been able to maintain inflation credibility, but you keep on getting high inflation prints. And so the denominator in nominal GDP ends up bringing down your debt to GDP ratio. So it seems like it's a win-win right now. So is inflation the way out here?
So it's a win-win for everybody but the bondholders, of
Small
course.
detail, but of course,
They,
it's important. Yeah.
may not be at the top of our collective valuation list. Who knows? But it's important here to distinguish surprise or unanticipated inflation from inflation more broadly. You're right that in 2021, 2022, debt to GDP ratios across the advanced economies came down by about 10% of GDP, largely because of inflation approaching 10% of GDP, automatically raising the denominator of the debt to GDP ratio, if you will, without involving an increase in the value of the outstanding bonds. If anything, the opposite. But then we know what happens is interest rates begin to adjust, and governments have to pay more in debt service on their outstanding debt. Maturities begin to adjust. Investors move from long-term debt, whose value inflation can erode, to short-term debt, which is not subject to erosion by inflation. So Sirkin and I look in our paper at the more general behavior of debt ratios in inflationary environments. We do find a short-term impact effect of inflation, but as soon as that inflationary shock is recognized, incorporated by investors into their expectations, any benefit in terms of reducing debt ratios goes away. And if anything, the earlier benefit is reversed out as interest rates go up and debt service becomes more expensive. And that's what you're beginning to see now in the United States. The debt in the hands of the public came down from a little more than 100% of GDP to a little more than 90% of GDP, heartening the debt scolds. But now everybody is worried about the cost of debt service going up even faster than defense expenditures and what that's going to mean for debt dynamics going forward. So inflationary surprises help here, but how many times can you surprise investors?
And in your study, the short-term benefit is often like 1 or 2 years, or can it be 5 years, say, or not? Was that unusual?
The answer depends on the term structure of the debt. What is the maturity of the debt outstanding? But for the vast majority of countries, any beneficial effect for debt ratios lasts for a decade, lasts for a year or two, and not longer.
Yeah. Okay, and in your paper you go on to talk about safe haven or safe asset demand, and I suppose this is particularly relevant for the US, which is the sort of the premier supplier of safe assets. So, do you want to talk more about that?
We emphasize that the US has more room to run, if you will, in terms of issuing debt to the public without incurring very much higher interest costs, because there is this very elastic demand from the rest of the world for safe and liquid assets as kind of the foundation of investor portfolios, both the reserve portfolios of central banks, but also the uh, uh, investment portfolios of banks and corporations, uh, and the like. They want a portion of their investment portfolios in the form of liquid assets that they can sell without taking losses in the event that they need cash, and assets that are likely to retain their value and even appreciate in value in bad times. Remember how in 2008 Lehman Brothers failed? We just uh, are having that anniversary, I think, on September 15th, if I recall. And when we did the bad thing and allowed Lehman Brothers to fail, the dollar gained value because everybody valued liquidity, and US Treasury bonds were the single most liquid asset in the world. So this means there is an appetite out there for US Treasuries that is not shared by other government bonds, British gilts, or what have you, to the same extent. We quantify that appetite in the paper. We observe that not only will the reserve demands of central banks and governments be rising over time as economies grow and trade continues to expand, but also the demand for these assets by the private sector, by corporate uh, investment managers and the like, will be going up as well. So that will moderate the increase in interest rates that the US will face. So the other factor we look at in the paper as a determinant of debt dynamics is R minus G, the real interest rate on the debt minus the real growth rate of the economy. And we observe in the paper that upward pressure on R, the interest rate on the debt, in the US case, will be moderated by the fact that there is this very large elastic demand for US Treasuries out there.
And actually, this leads on to the classic sort of the dollar question. And earlier this year, actually, it's been going on for as long as I've been in markets, but this year in particular, there's been a focus on China, India. These countries are starting to invoice their trade in their local currency. There's special alliances between certain Middle Eastern countries and so on. And people say the US is not credible anymore because of inflation or such things. So people question the dominance of the dollar. I mean, where do you stand on that debate?
I published a book in 2011 called Exorbitant Privilege, The Rise and Fall of the Dollar, and I argued that dollar dominance would decline over time because the weight of the US in the world economy would decline over time with the emergence of emerging markets and so forth. So along some dimensions, that has been the case. The share of the dollar in identified global foreign exchange reserves has fallen from about 70% of the global total at the turn of the century to 60% of the global total now. So that's very gradual, 1/2 of a percentage point a year decline in the dollar share. We've seen a modest decline in the dollar share of global trade invoicing and payments, but only very modest on that dimension. So I do see the world gradually moving toward a more multipolar international monetary and financial system that matches our more multipolar global economy, but only very, very gradually because the dollar has these strong incumbency advantages. Central banks around the world rely on the Fed for dollar swaps. They rely on the US banking system for dollar payments. They can tailor special bespoke arrangements for settling oil trade between China and Russia, but I think those are relatively small changes on the margin. Earlier this week, I had a Project Syndicate commentary on how global currencies die. And my argument there was that what Russia does, what China does, what the BRICS want to do in terms of establishing a BRICS currency might make a very small difference for the dollar's status globally over time, but the dollar's status rests in the hands of the United States. We have to get our political and financial act together over time, avoid another debt ceiling imbroglio at the beginning of 2025 after the next election, avoid a government's shutdown, et cetera, and get our fiscal prospects in order over time. Can you say raise taxes? So my argument there was the fate of the dollar rests in America's own hands at the end of the day.
Yeah, yeah, that's yeah, that makes a lot of sense. And then, finally on the debt side, there is the kind of the nuclear option, so to speak, restructure debt. How feasible is that? And in your study, how common is that being?
So debt crises have often led to restructurings of outstanding debt in history. So one of my sidelines is to work on that history. Debt restructurings have become messier and more difficult for the reasons we discussed at the beginning of the podcast, that China is a big bilateral creditor, but it's not an official member of the Paris Club of governments that restructure official loans. It's not obliged to follow Paris Club norms and conventions. It regards the loans of its big policy banks, many of them, as official loans, as opposed to commercial loans, and argues that its official loans ought to be exempt from restructuring. So other governments don't want to restructure if China won't restructure. Hedge funds try to hold out and buy the debt of governments seen as likely to restructure. And if their claims are not going to be written down at the end of the day, they're going to be bought off at 100 cents on the dollar to get their court cases off the table. Other creditors are reluctant to restructure because they would have to take larger haircuts on their claims, other things equal. So the so-called common framework of the IMF and the World Bank, the sovereign debt restructuring mechanism put in place in 2020 haven't amounted to much. There have been 3 or 4 countries that have reached provisional agreements. One country that seems to have reached now, Zambia, a final agreement with its creditors under the common framework, although all the details haven't been released. History suggests that completing these restructurings is a time-consuming process. The Latin American debt crisis erupted in 1982. The Brady Plan, which finally cleared away these debts, was put on the table in 1989, 7 years later, and took quite a number of years to completion after that. So my co-author Serkan believes that we might be at a point where the floodgates open and we see a wave of restructurings. I am more skeptical, but I hope he's right.
Okay, that's great. And if we step back a bit, I mean, does it make sense to think about sustainability of or certain thresholds of sustainability? At the top of the podcast, we talked about 100% as a nice round number, and obviously we've seen the work of Reinhard Rogoff and such. I mean, how do you think about the point of no return with debt levels?
So I think that it does make sense to think about sustainability. It does not make sense to think about magic numbers or thresholds that apply to all countries. The IMF now conducts debt sustainability analyses for all of its members every 2 years or in connection with programs. And it acknowledges, number one, that what is sustainable depends on things like the interest rate you face and the growth potential of the economy, how much you export, which determines the dollars that you can earn, and the foreign currency denominated debt that you can service. And the IMF acknowledges the uncertainty around all of these variables. So we can guess, but we don't know how fast an economy is going to grow over the relevant horizon of 10 or 20 years. So you end up with a fan chart or a series of scenarios, good, bad, and ugly, for how the debt might develop from here. So I think going through those numerical exercises is useful for concentrating thought, but you shouldn't take the numbers that come out too literally.
No, that's great. And so, all of this work, I mean, what do you think, if we just run through some of the major blocks, I mean, how do you see the impact of the US debt levels on the US, and what would you prescribe that it needs to start to think about?
Um, it's, there's a lot of uncertainty about this going forward. One of the big determinants of US debt dynamics, according to the Congressional Budget Office, is Medicare, Medicaid costs. And we seem to be seeing some evidence now of success at bending the healthcare cost curve. But as I said at Jackson Hole, it's above my pay grade to imagine what's going to happen to the relative cost of healthcare going out 10 or 20 or 30 years. We simply don't know. But if you look at entitlements more generally, if you acknowledge that the US is going to have to spend more on defense, the peace dividend has gone away. Debt dynamics are disturbing, and I think we mainly have to reach agreement on raising more revenue in the United States. And I'm deeply worried, given political dysfunction, given political polarization, about whether we can do that or not, short of a crisis of confidence in the dollar and the US Treasury market. So I wouldn't rule out the possibility that the latter could occur, nor would I give you a date for when it might occur, consistent with those earlier remarks on debt sustainability. There's a tremendous amount of economic, financial, and fundamentally political uncertainty about how these things will play out. But the world economy depends on the United States for liquidity, for a source of safe and liquid assets that can be used to settle transactions across borders. This kind of crisis in the United States would be seriously bad news for 21st century globalization and for the world economy more broadly.
And in terms of the rest of the advanced economies, I mean, do they have a similar trajectory or similar concerns as the US, or would you
Yeah, they
characterize
do.
them as slightly
They
different?
they
Yeah.
they do. And if you look at the European economies, for example, growth prospects are, if anything, less promising than in the United States. The more limited international role of the euro means that interest costs could be going up more rapidly than in the United States. Having said that, we know that Europe is a complicated place, and comparing Italy on the one hand with Germany on the other hand, the debt situation is much more alarming in the former than it is in the latter. Things can change relatively quickly. A few years ago, we were all despairing about the debt profile of Japan. Now everybody is reassured that the Japanese economy is growing without interest rates going up significantly. Again, this is a reminder that the tables can turn. I think overall, the debt situation is most alarming for developing countries that have debt burdens that are unsustainable by most measures, that have to be restructured, and that haven't been restructured under the common framework, and that have limited growth prospects until those debt problems are normalized.
And these are some of the smaller developing countries. These are not the big. It's not like the Indias or the Chinas. These are the sort of
Right,
what we call the frontier.
as we said before, that the big emerging markets have moved very significantly in the direction of issuing domestic currency debt, even to foreign investors, not so much smaller developing countries.
Yeah. Now I know this isn't your area of specialization, but I saw at Jackson Hole there was some talk about structural growth trends, and when I speak to clients often or investors, they often sort of talk about AI as being the big technological shock that could solve all of our growth problems. I mean, and I know you're a great economic historian as well as a great economist. I mean, how would you view this AI revolution?
Well, I'm a believer in using history cautiously, that we not only want to look to historical parallels and similarities and analogies, but also differences between the past and the present. If we use history mechanically, it suggests that it will take a decade and more before AI and all that translates into significantly faster productivity growth economy-wide, that firms have to fundamentally reorganize how they do business before AI begins to have a payoff in terms of faster overall productivity growth. So it took several decades for the steam engine, took several decades for electricity. It took several decades for the internal combustion engine and trucking to translate into faster productivity growth as firms had to figure out who to hire, who to fire, and who to retrain, how to reorganize what happened on the factory floor, et cetera, for those new technologies to have a positive productivity impact. And I would, and history suggests that could be true of AI as well. So there was a little bit of pushback on that at Jackson Hole, where people were suggesting that maybe this time will be different, and that in this more flexible, rapidly moving digital world, firms will figure out how to reorganize and capitalize on these new technologies more quickly. It took 10 years more than 10 years from the first practical personal computer circa 1982. That's when it came to my office, to the new economy, the acceleration in productivity growth in 1995, 13 years before the productivity payoff then became evident. So will this time be different?
Yeah, we'll see. Yeah, well, that's a great note to sort of to end the interview here. By the way, what's the best way for people to follow your work?
Project Syndicate, as I mentioned before, I do an weekly, a monthly, sorry, a monthly column there, and I advertise everything else I do on Twitter,
Right. No, that's
where
excellent.
I'm B_Eichengreen.
Okay, I'll add links to everything you just mentioned. So once again, thanks a lot for participating in this podcast, and keep up the great work as well.
Good, and we'll talk again, Bilal, in 3 years.
Exactly. Yeah. Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.